Welcome to the deep dive, where your shortcut to understanding the big forces at play. And today, we're diving into the State Bank of India, SBI. I mean, it's pretty much the financial backbone of the country, right? Understanding how an institution this huge is doing its financial pulse isn't just for, market watchers. It really matters for everyone, affects the whole economy. So our mission today, we are going to unpack SBI's results for the first quarter of fiscal year 2026. That's the period up to June 30th, 2025. We've gone through the official stuff, the analyst presentation, press release, board meeting outcomes to really pull out what matters for you. The goal isn't just reading numbers. We want to get behind them. What's driving things? What strategic moves are they making? And what does it all mean? Okay, let's unpack this. All right, starting with the big picture. SBI has definitely had a strong start to FY26. The headline number. Net profit at 19,160 crores. That's up 12.48% year on year. Now, for a giant like SBI, what does a double-digit growth figure like that actually signify?
Well, yeah, that 12.48% for a bank of SBI's sheer size, that's really striking. It's not just strong, it suggests, they've got this rare mix of market dominance, but also like agile management. Think about it. Usually big established players find it harder to grow that fast. So for SBI, it kind of points to their ability to squeeze value even from mature businesses and navigate the economy pretty effectively. It translates to a really solid bottom line.
Right. And it's not just net profit looking good. Their operating profit also jumped, crossed 30,544 crores. That's a 15.49% year-on-year increase. Healthy. And then you look at the profitability ratios. Return on assets, ROA, for Q1 FY26 was 1.14%. Return on equity, ROE, was, 19.70%. Now, these are clearly strong ratios. For our listeners who follow this stuff, what do these specific figures, the 1.14% and 19.70%, tell us that SBI's efficiency may be compared to others, and why is that so important long term?
Yeah, they are compelling numbers, and they mean more than just the textbook definition, right? Think of ROA, that 1.14%, like an engine's efficiency. How much profit are they getting out of every bit of asset they control? It tells us they're pretty darn efficient at turning that huge asset base into earnings. And the 19.7% ROE. That's even more direct for shareholders. For every rupee of equity, they're generating almost 20 pays in profit. For a public sector bank this big, keeping that kind of efficiency up, it signals really good capital allocation, strong returns for owners. It definitely sets them apart from peers who might struggle with profitability at this scale.
Okay, but here's where it gets really interesting, maybe something to chew on. We saw a slight dip, just tiny, in net interest income, down 0.13% year on year. And the net interest margin, NI, for the whole bank was 2.90%. Domestic NIM was a bit higher, 3.02%. So that slight NII dip, it feels a bit counterintuitive when everything else looks so strong. What's maybe going on under the surface there? Why is that intriguing?
That is a sharp observation, yeah. While overall profits are up, that slight dip in NII, the core earnings from lending, basically it can be a leading indicator sometimes. It suggests that, okay, maybe they're doing great on other income like fees or trading and managing costs super well, but maybe the pricing power on their main lending business is facing a little pressure. Or perhaps the cost of funds is creeping up slightly. It's just a reminder, even strong banks operate in a tough, competitive interest rate world. Managing that NIM is always a strategic juggle.
Right, makes sense. So with profitability looking good overall, the next question is how are they actually fueling this growth? Let's look at the engine room, the loans or advances and the deposits. Whole bank advances grew 11.61% year on year, reached a massive 42.5 lakh crore. That's huge. Breaking it down, domestic loans grew 11.06%, and their foreign offices, even stronger growth, 14.81% year on year.
Solid growth across the board there.
And digging into that domestic loan book, it's clear they're spreading their bets. Corporate loans grew steadily, 5.70%. Okay, but the real drivers, SME loans, small and medium enterprises, they surged 19.10% year on year. Impressive. Followed by agri loans, up 12.67%, and retail personal loans, up 12.56%.
Wow, SME leading the pack like that.
Yeah, and that retail personal portfolio is about 15.4 lakh crores now. Home loans within that grew 15.05%. And get this, SBI holds almost 28%, 27.7% to be exact, of the entire home loan market.
28%.
So this focus on smaller businesses, farming, retail, what does that tell us about their strategy, especially for a bank this big?
Well, what's fascinating here is that strategic diversification. For a public sector giant, seeing such strong growth in SME and agri, it signals they're actively moving into areas that are high growth but maybe underserved. These segments can often offer better margins than just lending to huge corporations, though the risks are different, of course. It also fits with national economic goals. and holding nearly 28% of the home loan market. That just shows how dominant they are in a core part of Indian consumer finance. It really underlines their ability to tap into broad economic activity, not just rely on a few big corporate clients.
Okay, now let's flip to the other side of the coin. Deposits. Where's the money coming from? Whole bank deposits crossed 54 lakh crore. That's an 11.66% year-on-year growth. So deposits growing slightly faster than loans.
Good sign.
And their SAFA deposits, current account and savings account, grew 8.05%. The HSOR ratio, which is key, stood at 39.36% as of June end. We also noted that building up these deposits, especially savings accounts, is a big focus. They've got a 5-year growth rate of 6.2% and a 10-year rate of 12.5% for savings accounts.
Right, that low-cost funding base.
Exactly. So connecting these dots, strong loan growth, fueled by this solid, cost-effective deposit base, what are the implications?
It's really textbook healthy banking, isn't it? A high CASA ratio like SBI's, almost 40%, means a huge chunk of their funding is very low cost. These accounts pay little or no interest. That directly helps their net interest margin, kind of cushions against that pressure we maybe talked about earlier. So having both sides, strong, growing, good quality loans in diverse areas, and having a stable, cheap funding base that creates a really powerful engine, it's built for long-term profit and resilience, lets them lend competitively but still keep healthy margins.
Makes sense. Okay, moving on to asset quality. Always crucial, especially for SBI. And here they've shown some really significant improvements. The gross non-performing asset ratio, gross NPAs, improved by 38 basis points year-on-year. It's down to 1.83%.
It's quite low.
And the net NPA ratio after provisions improved too, by 10 basis points. It's now at a very lean 0.47%.
Very lean indeed.
Their provision coverage ratio, PCR, stood at a healthy 74.49%. And interestingly, if you include something called Advances Under Collection Account, or AUCA, these are basically fully provided. For bad loans, they've moved off the main books to clean things up. Worth about 1.62 lakh crore, the PCR jumps way up to 91.71%.
Okay, let's break that down. That's 74.49% PCR. That's already a strong safety net, right? For every 100 of recognized bad loans, they've already set aside almost 75. And including AUCA, those old problem loans they've fully dealt with and shifted aside, that coverage hits over 91%. That speaks volumes, really, about how proactive and conservative they're being with risk.
Right. We also saw the slippage ratio that's new loans turning bad was 0.75% for the quarter. That's actually an improvement 9 basis points better year-on-year. And the credit cost was 0.47%. So this does raise an important question. How do these metrics taken together truly reflect their risk management and the health of the loan book overall? Any subtle signals we should maybe watch?
Yeah, you've really hit the core of it. Those improving NPA numbers plus that really robust provision coverage. It signals SBI has been, well, remarkably effective, both at getting money back from bad loans and setting aside funds proactively for potential future losses. That high PCR, especially with AUCA factored in, shows their conservative accounting and, frankly, a commitment to transparency. It fundamentally strengthens their balance sheet. Now, the subtle point. While the numbers look great, you always have to keep an eye on new slippages. That 0.75% slippage ratio is good, very good. But in a dynamic economy, keeping it that low needs constant vigilance, strong underwriting, good monitoring. But overall, yeah, these are definitely strong signs of a well-managed credit portfolio.
Okay, let's talk capital, man. The bedrock, right? The safety buffer. SBI's capital adequacy ratio, CAR, was 14.63% at the end of Q1 FY26. Decent cushion. But the really big news this quarter, frankly, a game changer, was that huge equity issuance. India's largest ever, apparently, a 25,000 crore qualified institutional placement, or QIP. So basically a massive share offering to big investors. They issued about 30.6 crore new shares on July 21st, 2025.
That's a massive infusion.
It's huge, and the impact is substantial. It wasn't just raising money. It boosted their core equity tier 1, the CET1 ratio, to 11.80%. Or 12.33% if you count the Q1 profit, and it pushed their total CAR up to 15.33%, or 15.86% with the profit included. Now, this creates a really significant CR buffer, 3.56% above what's required by regulations. And they estimate this buffer alone could support credit growth of around 12.50 lakh crore.
Wow.
So how does this QIP fundamentally change SBI's game plan, their growth path, their risk profile, looking ahead?
Yeah, this QIP, it's a strategic masterstroke, especially for a public sector bank. It's way beyond just meeting the rules. It's about building an enormous war chest, that 3.56% buffer, supporting potentially 12.50 lakh crore in new lending. That's staggering. It just gives SBI so much room to grow its lending without worrying about capital. It positions them incredibly well to ride India's economic growth, go after new opportunities aggressively, and importantly, absorb any unexpected market bumps. It signals huge long-term confidence from investors and regulators, really de-risks their growth story.
Okay, beyond the pure financials, SBI is also making big strides, really leading in its digital transformation and efficiency, which is pretty impressive. Get this, 98.6% of their transactions now happen through alternate channels, online, mobile, ATMs, not branches. That's up from about 98.2% a year ago.
Almost everything.
Yeah. It's not just a number, right? It shows a massive shift in how customers bank and how successful SBI has been in driving digital use. Their YONO platform is obviously a huge piece of this. It now has 9.04 crore registered users, 9 crore. And incredibly, 66%, two-thirds of all new savings accounts opened in Q1 were through YONO.
66%. That's amazing penetration.
It really is. And just to give you a sense of the scale, they handled 1,366 crore UPI transactions in Q1 alone. Just massive volume. Now, this digital push seems to be paying off in efficiency, too. Their cost-to-income ratio improved to 47.71% for the quarter, down from 49.42% a year earlier.
Right.
So what's really intriguing here is seeing this digital adoption for such a traditional huge bank translate into these tangible savings and presumably a competitive edge.
Oh, absolutely. It's a huge testament to their digital efforts. For a public sector bank, which, let's be honest, are often seen as slower movers, these digital stats are genuinely world-class. When two-thirds of new accounts come via YONO, that slashes branch costs, makes onboarding way more efficient. The huge UPI volume shows they're dominant in digital payments, and that falling cost-to-income ratio, that's the direct financial result. Shifting transactions to cheaper digital channels lets them streamline operations, boost income, control costs better. This isn't just convenience for customers, it's fundamentally changing their cost structure, makes them much more competitive against, the agile private banks and the fintechs popping up everywhere.
Right. Now, beyond the immediate results, SBI has also been making some interesting strategic moves, things that shape its future. One notable one was selling its entire stake, 14.96% in Geo Payments Bank, sold it to Geo Financial Services back in June. They booked a profit of about 25.46 crore. Relatively small profit number. Yet the profit itself isn't huge. So what does this divestment maybe signal about SBI's bigger strategy in the whole digital payments arena?
That's a good point. You're right. The cash isn't the main story. This move is likely more about strategic focus. It suggests SBI might be kind of streamlining its own digital ecosystem, maybe concentrating resources on its big platform, YONO, or perhaps exploring different kinds of partnerships, rather than holding a direct piece of a niche payments bank. It could hint at a clearer, more consolidated vision for their digital payments future and where they want to really focus their efforts.
Interesting. They also did a revaluation of their freehold properties. That added a net surplus of about 7,288 crore to their revaluation reserve, just reflecting updated values.
Right. Unlock some hidden value on the books.
And structurally, there were changes with the regional rural banks, the RRBs. 5 SBI-sponsored ones merged with RRBs sponsored by other banks. So SBI sold its stake in those, about 1,086 crore, but it had no impact on their main P&L. But then, conversely, SBI became the new sponsor for Rajasthan Gramin Bank, buying that stake for about 108 crore.
Okay, so some shuffling there.
Yeah. What's the likely strategy behind these structural tweaks and the asset revaluation for a bank like SBI?
Well, the property revaluation is fairly straightforward. Helps the balance sheet better reflect true asset values, enhances transparency, maybe even helps their borrowing capacity a bit. The RRB changes are more interesting strategically. It points towards a longer-term plan to rationalize and consolidate their rural banking network. By selling some stakes and buying another, SBI seems to be optimizing its footprint in rural areas, probably aiming for better operational efficiency, maybe more focused financial inclusion efforts and specific reasons, all without messing with their main profit numbers directly. It's about positioning that rural network for the future.
Got it. And it's not just pure finance anymore, is it? ESG, environmental, social governance is a big focus too. SBI has formed a dedicated ESG and climate finance unit. They got a long-term goal, net zero emission scope 1, 2, and 3 by 2055. That's ambitious.
They're very ambitious, and they're putting money behind it. They finance a lot of renewable energy projects, supporting over 41 GW of capacity with nearly 75,000 crore in funding limits. Plus, little things add up, planted over 500,000 trees under CSR in Q1.
This feels like more than just, corporate fluff, right?
Oh, absolutely not fluff. For a bank like SBI, so deeply woven into the Indian economy, a strong ESG commitment is becoming, well, a strategic necessity, not just a nice to have. That net zero by 2055 goal, that requires real fundamental changes in how they lend, how they operate, and financing so much renewable energy, that puts them right at the forefront of India's green transition. It opens up new business opportunities for them while also helping manage climate risks in their portfolio.
Mm.
It's really about building a sustainable, resilient business for the long haul, aligned with where the country and the world are heading.
Right. Now, to really get the full picture, we need to zoom out slightly and look at the whole SBI group, including its subsidiaries. This is where you see the ecosystem strength. SBI Life Insurance, for example, reported 14% year-on-year PD growth, 594 crore. And their assets under management, SOM, grew 15% to nearly 4.76 lakh crore.
Solid performance there.
Then there's SBI Cards. Revenue from operations up 12% year-on-year, PIT at 556 crore. And SBI Mutual Fund, still the biggest player in India, 15.80% market share. Their quarterly average AUM grew by 1.52 lakh crores to reach 11.40 lakh crores. Huge numbers.
Dominant.
So what does the strong performance across these key subsidiaries tell us about the overall strength and maybe the strategic value of the SBI Group as a whole?
It tells us SBI isn't just a bank anymore, right? It's a full-fledged financial services conglomerate, a powerhouse. The fact that its subsidiaries, life insurance, cards, mutual funds are all doing well shows they can leverage that massive customer base and brand trust across many different financial products. That diversification really helps de-risk the main banking business, provides multiple streams of income, multiple avenues for growth. It's about building this resilient ecosystem where all the parts kind of support each other. Makes for a really formidable position in the market.
Yeah, and bringing it all together, the consolidated net profit for the entire SBI group was 24,201 crores. That's up 9.71% year-on-year. And the group's total assets grew to, well, an almost unbelievable 74.44 lakh crore, up nearly 10% year-on-year. Those numbers just underscore the sheer scale and the comprehensive health of the whole SBI conglomerate.
Truly massive scale.
So, okay, let's wrap up this deep dive. SBI's Q1 FY26 results. They really paint a picture of, I'd say, comprehensive strength and pretty clear strategic thinking. We've seen solid profitability, impressive profit growth, along with those significant gains in asset quality, lower NPAs, high provisions.
Key strengths.
And the bank's focus on diverse loan and deposit growth, plus that big push on digital and smart capital management like the QIP. It all seems to position them really well for continued momentum. Our goal here was to give you that quick but thorough understanding, getting beyond just the headlines to what's really going on. So the final question, really, is what does all this mean for you? When a foundational institution like SBI reports such strong results, keeps its capital strong, its loan book healthy, that sends a really powerful signal of stability across the whole economy. Think about it. A strong SBI could mean easier credit for businesses, more confidence for investors, just a more stable financial environment for everybody. It really raises a fascinating question for the future, doesn't it? How might the sustained strength of India's biggest public sector bank keep rippling through economic confidence and investment trends across the whole country in the months and quarters ahead? Something to think about.